everyone. Thanks for joining us today. Apologies for the small delay. As before, the webinar will be led by Jerome Stern and supported, and Chris Rosbach, our CIO. They'll be joined by Giles Tulloch, our global technology expert. Our plan today is to talk about our performance, the developments in AI, its spread across and within our portfolio, ESG, and of course the outlook. I'll now hand over to Jerome Stern.
Thank you, Sandy. A warm welcome also from me to our World Stars Global Equity webinar. A lot has happened at J. Stern & Co, as well as at our strategy since our last update. We have quite some news to report to you. First of all, we're an investment partnership, but now managing $1.7 billion AUM on behalf of institutions, endowments, wealth managers, and families, whereas 20% continues to be managed on behalf of my family. Our flagship investment strategy, World Stars Global Equity, represents $1.4 billion US. Earlier this month, we launched World Stars in a Delaware LP fund to offer our strategy to eligible US investors, and raised more than $340 million US on behalf of 21 US institutions, endowments, pension plans, and family offices. This is a phenomenal success and cornerstones the continued growth of our firm in the US. Over and above that, the launch of a US LP dovetails well into the continued asset growth we have been able to have over the past years, driven both by new client funds and by great performance, which Chris will describe. In addition, our World Stars investment team has just a few days ago celebrated its 10-year anniversary of working together, underscoring both stability, experience, and success across a wide variation of economic environments. Let's now move on to our investment philosophy. As you remember, quality is for us the defining condition to invest in a company. We define quality as strong and sustainable market competitive position, operating in a good and growing industry, led by a management with a great track record of value creation, and a company which has the financial strength to weather any type of adversity. If a company does not display these qualities, it can be as cheap as it wants. We will not invest. In addition, our approach continued to be extremely selective. We only focus on 4 areas, and we avoid 4 other areas of our investment universe. We concentrate on our efforts on digital transformation, on the global consumer, on healthcare and life sciences, as well as on industrial and infrastructure. Equally focused, we avoid wholeheartedly balance sheet-driven financials, resource companies, regulated industries, and capital-intensive businesses. Moving on, I wanted to show you an interesting analysis. Our World Stars Global Equity strategy is now in its 12th year, led by the same team. The chart below demonstrates that our strategy has outperformed the MSCI World in 64% of all the 3-year rolling periods. This continues to show consistency and reliability of our investment process. At this stage, I will hand over to Chris.
Thank you, Jerome, and welcome everybody to this first webinar of the year. And as Jerome highlighted, we want to provide an update on performance and on some of the issues that we're thinking about, as well as about the outlook for this year. I want to start off by highlighting the performance and talk both about the calendar year 2023, because this is our first opportunity to talk about it this year in this format, and then also about the year-to-date performance. I think it's very important to highlight how strong our World Stars Global Equity strategy has performed. You can see that it was up 29.5% in US dollar terms in calendar year 2023, which compares very favorably to the MSCI World, which was up 24.4%. And you can see that over the last 5 years, 10 years, and to 2015, which is when our investment team came together, that you can see that we have outperformed the market as well. Our goal is to generate absolute returns from investing in globally leading companies that have the quality attributes that Jerome just described, and that we can buy at valuations that allow us to generate strong compounding returns. So it's an absolute target, but clearly we look to add value compared to the MSCI World, which is the most appropriate benchmark that you might use to compare us. And so it's important to note that we've been able to achieve that. It's particularly notable if you compare that to the performance of 2022, when the stocks we own declined as part of the very rapid rise in interest rates that has now led us to the normalization that we've experienced in last year and this. And we've had the conviction, I think, that was very clear, that said that we've taken the hit in terms of many of the underlying drivers. We've taken the blows on inflation, which is now moderating. We've taken the blows on interest rates, which are now normalizing, and we've taken the blows on valuation with a significant derating that many of our companies went through in 2022, and which was only partially reversed in 2023 when markets performed strongly. Many of our stocks did as well, that led to the performance, but at the same time their results grew so quickly that they are still at very attractive values. And if you recall from what we were saying in the fall of last year, we started our commentary for the month of September saying caveat venditor, a play on caveat emptor, buyer beware. We said seller beware, because the combination of the short-term reversal that took place in the third quarter of last year with the strong underlying results led to a valuation anomaly, meaning that many of the stocks we owned were extremely cheap. And I think we were not surprised to see how strongly the markets and our portfolio performed into the end of last year and into the beginning of this. If we turn to the performance for this year, you can see that we also did extremely well. So the performance for this year, we are up in US dollar terms 10.2% compared to 5.4% for the market. And so this strong performance has continued, driven by the results of the companies, as well as by the cheap valuations that they're trading at. If we can now turn to some of the detail that I want to take us through, then one of the things that we've talked about is the factor attribution. So looking at the underlying drivers that affected our portfolio and the stock selection that we ourselves contributed to that. So this is a chart that we've shown you at different times. It goes back to March 2020, which covers this whole period of great dislocation from the pandemic, with the central bank actions taken to effectively increase quantitative easing and take rates to zero, and then the reversal. And the important thing to look at is the active return, which is the gray line, the factor return, which is the pink line, and the selection effect, which is our own selection of stocks, which is the darker line. We highlighted before that throughout this period, the selection effect has remained either strongly positive or at times dipped down to neutral throughout. And in particular, if you look at the period that starts at the end of 2021 and runs into 2022, which is this big reversal that took place, you can see that that was almost entirely driven by factors. So these are things like value versus growth, its size, its momentum, its some other indicators that are largely related to the interest rates and to this short-term rotation between growth and value that markets undertook. You can see it was that took the active return down. In the third quarter, there were some stock-specific issues as well that affected the portfolio. But the really important thing to highlight is if you then look at what happens at the end of 2023, and that really defines, of 22, and that defines 2023, then you can see the first thing that happens is that the pink line reverses. It starts to go up. That's when markets realize that rates have run their course and that we are now more stable and that the underlying economy is doing well. But you see then the pink line starts to flatline through 2023, and the black line goes up, and that's a selection effect. So this is our ability to look for stocks that perform strongly and contribute to the performance. What you then see, and likewise, this is part of the review for 2023, is you see the pink line going down again. That's this reversal. We were saying at the beginning of last year that one of the key risks we saw for the overall market was when the markets were going to realize that rates were not going to come down as much as people thought, because they didn't have to, because the underlying economy would be stronger. And that's exactly what happened. And you can see through that period, our selection effect stayed basically constant within a narrow band. And it was purely the factors that took the market down, which led us to say this is an extraordinary valuation opportunity. And of course, what you can see there is what has happened since, is that the factors have actually remained relatively stable, although they've recovered somewhat, but that our selection has continued to perform extremely strongly as the market broadened at the end of last year and beginning of this. And so it was not just about some of the stocks in digital transformation that did much to drive the performance in 2023, but it is the much wider range of companies that are cheap and that are in our portfolio that have contributed to performance, and that give us the confidence we have for this year. If we then turn to the attribution analysis, and I'll just touch on this briefly, I do want to highlight that even though you might look at the portfolio and some of the names and have the impression that it's driven by these digital companies, after all, it is NVIDIA, it is Meta, it is Amazon and Alphabet and other companies that have done a lot to generate our performance. What I want to highlight here is the actual underlying allocation that comes from our risk system. And to show you, in particular, if you focus on the bottom two bars, that if you look at the gray bar, which is the actual allocation effect of what we have, then you can see that communication services and information technology are roughly offsetting. So relative to the MSCI world, we are neutral, those two sectors. We are not overweight in aggregate technology, and we're actually underweight information technology. So what drives the returns is the dark blue bar here again, which is the selection effect. It ties back to the chart that I showed you before. And it shows you that in most cases, we have been able to add value in important areas of the companies that we invest in, and that you can see that where we have both allocation and selection, we are often making a positive impact from the selection. So it's something that we monitor as part of our portfolio management, but it is an important explanation for what you see in terms of the performance. And if we just briefly roll forward to 2024 year to date, it's actually an even stronger picture. If you look at what where we're generating value, and you can see that, for example, it continues in terms of the exposure to communication service and information technology. It continues builds in terms of consumer discretionary, but you can see, for example, that industrials, which was a laggard last year, has started to perform, and you can see that even though we're roughly flat in terms of allocation effect, you can see that the selection effect there is now positive. So again, it's the broadening, it's the diversification of the portfolio that is contributing to the performance, and that is giving us the confidence in what it's going to do going forward. And then if we roll just to look at what that means in terms of some of the actual names in a way that I think is even more graphic, this is what the individual stocks, the currently 29 positions that we have in the World Stars Global Equity Strategy, did last year. You can see the top performers were NVIDIA, Meta, and Salesforce. And from the color coding in our own classification, you can see that the top 6 were in digital transformation, as you would expect. But I do want to highlight that it's not just them, because you see below a great diversity of other types of companies in other businesses that have contributed positively to the performance. And that, again, is something that we saw in the fourth quarter. And if we roll forward to the 2024 returns, you see it's more diverse. It's still NVIDIA, which is our largest position. It's still Meta, which is recovering from the extraordinary sell-off that it had, and turns out, of course, to be an absolute AI winner and not challenged by it, and so forth. And it is ASML, which we bought in January of 2023, recognizing that there's a need for an increase in computing capacity, and Giles will talk us through the overall thesis and how it applies to NVIDIA and other things. But the really important thing to highlight here, again, is the diversity of the other stocks that are there. And so some of them have done well, others are still catching up, but we think that there is a great deal of value there, and even though the performance has been as strong as it is, again, the results have kept up. And so, as we'll highlight later, the valuation for the overall strategy is still extremely attractive. And so with that, I want to pause and I want to hand it over to Giles, who will talk to us about AI, how we see it impacting NVIDIA and its broader implications for the portfolio. Giles?
Great. Thanks a lot, Chris, for the introduction there. Yes, as sort of Chris was mentioning, artificial intelligence, or AI, is probably the most important topic for us sort of technology investors right now, and arguably, I'd say, for the stock market in general. We've talked about a lot about AI in the past, in particular, our initial investment into NVIDIA at the start of 2022, where I thought it was worthwhile just setting out a little bit more our sort of thoughts on the development of artificial intelligence. We think there are 4 stages of AI, and we've gone through the first stage, the predictive AI. This is very much the sort of recommender systems. You might see it in terms of, say, social media, where they might populate the next sort of viral video for you to engage with, or maybe say in e-commerce, the next sort of item commonly purchased with other items in your basket. But we think we're now into the generative AI stage, so the second stage of AI, where the artificial intelligence is able to create a unique piece of content based on a sort of a human prompt. There are other stages to artificial intelligence, autonomous AI, where it won't need to have the human intervention, and then AGI, where the artificial intelligence will have its own sort of feelings and be sentient. We still think those are probably a long way off, and that generative AI still has a long way to go. And so what does that mean for us as investors? We think this is basically the start of the next computing cycle. We think that this is going to demand a whole new range of applications and sort of systems. And we've seen the development of computing cycles going through in terms of the starting off with the sort of the mainframe, moving on through to sort of the PC, into the desktop and the mobile internet. There's been a log scale incremental growth of units. You can see there it's gone from, say, 1 million units of mainframe up to 100 million units of PC. And now we're into the sort of mobile internet and AI era, where there's tens of billions of units. And so you have these sort of tens of billions of units because you need to have this enormous amount of data in order to train the large language models, which are sort of the brains behind the artificial intelligence. And so this all requires an exponential growth in compute capacity. You basically need to have very complex systems, and it requires a lot of power. And it's only been now that we've been able to have generative AI because we've now got the technology. And that technology is basically powered by NVIDIA. So NVIDIA, what they do is they make accelerator chips. And so what an accelerator chip does, it basically takes the computing process in a different fashion. It does it in sort of parallel rather sequential. But what this meant is that NVIDIA, based in the company, has allowed us to have these large language models and generative AI. I think it's quite important, even though the stock's been a winner, to look at just some of the numbers which they reported in their last quarterly earnings last week. You can see they reported revenues of 22 billion, significant growth year over year, but also as well as the margins, which we think are very attractive. It did an EBIT margin of over 65%, which is just testament to how strong the business is for NVIDIA. It also has a very large market, which it is addressing. It's over sort of $1 trillion. And you can see there on the chart below how NVIDIA are sort of projecting the market growth going forward. One question we've been asked has been about the competitive advantage over sort of NVIDIA's products compared to, say, some competitors. And we still think that it's got a very strong competitive moat. In particular, it's launching new products at a very fast cadence. So you can see here, even though there's lots of sort of code names, you can see a lot of product which NVIDIA are bringing out in 2024, the second half of 2024, and through into 2025. And it's not just the GPUs, which is their sort of core chip that they're bringing out. They're also bringing around other products, creating an ecosystem around the GPU. So they have, like I say, the CPU and GPU, also the DPU, the data processing unit, and also even Quantum and Spectrum X, which is their sort of networking products. So it's not a one product company. In fact, it's an entire full stack. And we think this fast cadence of new products coming out means it'll be very difficult for competitors to launch their own equivalent. And so there's still rapid growth ahead for the company. There's still, we're basically reaching this tipping point, we think, in terms of accelerated compute and generative AI. And we think it's very important sort of quote which the CEO, Jensen, made in the last quarterly earnings about $1 trillion installed base of data centers transitioning from this sort of general purpose compute to accelerate compute, which basically means that NVIDIA have got $1 trillion market which could probably transition over towards their products in future. And so despite the rapid growth in revenues that they've had, and obviously increase in profits, it's got a very long runway ahead. But it's not just NVIDIA that benefits from artificial intelligence in our portfolio, and there's other companies as well. So in software, Adobe with their Firefly artificial intelligence product, or Salesforce and Einstein AI, they've launched these new products over the last year, and they've had good uptake and good success. There's ASML, which is a Dutch semiconductor equipment manufacturer whose advanced machinery is basically the key tool in order to make the advanced logic chips. And there's also Eaton as well. So Eaton is one of our industrial holdings that's with sort of power management. And as I mentioned before, the data centers are very power hungry. And so this has caused increased demand for Eaton products to manage this power workload. But saving the best till last, and it's Meta. Meta has been the parent company of Facebook and sort of Instagram. I've talked a lot about Meta over the last sort of few webinars and sort of defending the sort of share price performance during sort of 2022, but it's performed very well through 2023 and onwards. And I think it's just important to sort of remind ourselves that Meta were one of the early companies to invest into artificial intelligence to have a business impact for the company. During 2022, they were dealing with Apple's IDFA changes and the cookies and the lack of sort of signal that they were receiving. And so they built their own AI systems to try and replicate that loss of signal. What this has meant is that aside from just being a predictive and sort of recommender engine, you can now use generative AI to sort of predict, to build adverts which are sort of customed for each individual sort of user, which is then delivering much better return on investments for advertisers. And so you can see from the recent sort of quarterly earnings, you're seeing advertising impressions increasing by 21%, but also as well, you're seeing these sort of headcount reduction of 22%, which then basically meant that Meta have been able to report much stronger revenues, but also as well at much higher margins. So it's a very compelling proposition of seeing accelerated revenue growth, but also as well of a lower cost base. So we still remain very confident with Meta and its sort of underlying business drivers going forward. And so with that, I'll pass it back to you, Chris.
Yeah, well, thank you very much, Charles. I think it's if you look at that share price chart on Meta that you just showed us in the previous slide, then I think if there's any argument that shows you that markets can overshoot and get things wrong in the short term, I think there's a very powerful argument. Clearly, Meta was facing issues in terms of the expected growth of digital advertisement and the cost base that they were incurring in 2022, but nothing justified the sell-off of the shares down to $100. And so the fact that they're now up to all-time highs, as high as they are, and that they've almost quintupled from that low is just an indication how important it is to do the fundamental work, to keep focused on what the companies are doing, to keep looking at what is going on in the industry and with other businesses around them, and to keep the conviction where there are these dislocations. And we had obviously called out, as Giles, you highlighted, that it was an extraordinary opportunity. Meta was one of the cheapest stocks in our portfolio for a long time. And we have other opportunities right now where there are similar mispricings because of similar short-term overestimations. A company like Meta is subject to great constraints, not least the market and the share price itself. And so the fact that Mark Zuckerberg and the management took decisive action is something that we think is very much in line with what we would expect a company like that to do. I now want to move forward and speak a bit about what we're seeing right now, some of the issues that we're looking at, and to talk about the outlook. The first thing I want to touch on very briefly is the earnings outlook after the fourth quarter of last year. And so we've showed you here a number of the companies that are in the WorldStars Global Equity Strategy. And as you can see, 12 stocks ended the last year, even though with the strong performance, with estimates that were higher than what was initially expected, and 9 of them had unchanged EPS estimates. So the vast majority of stocks in the portfolio have done very well, and in fact exceeded expectations in terms of what people were expecting for them. So we're very glad to see that, and obviously in some cases it's large. I think it's important to see Walt Disney as one of those, which is in the process of turning around. And at the same time, I think you can see that there are some companies where that was not the case, and in particular, that's in some of the consumer companies that have been impacted by still issues related to the pandemic in terms of their inventory situation and destocking and restocking, like Pernod Ricard and Diageo and spirits, but also the delayed impact of the inflation and the interest rate rises in the case of broader consumer staples companies like Nestle and L'Oreal in particular. But we expect those to reverse, and in fact, we think that some of those more steady businesses that have derated as part of what has happened over the last year and two represent very compelling opportunities. I then want to speak briefly about the leading into how we tie these different drivers together. Giles talked about AI in terms of the impact that it has on companies across the portfolio. It's obviously not just the companies that are enabling it, like NVIDIA and ASML. It's not just the platforms, including the ones that offer cloud computing, like Amazon and Alphabet. It's not just the software companies like Adobe, which is one of the leaders with its button, filling in images from a generative AI model trained on its own proprietary photo stock, or Salesforce. It's not just companies like Eaton, but also Amphenol and Sika that are putting in the infrastructure that allows this investment to take place, and both data centers, warehouses, logistics, and other types of facilities to operate. It's the wider set of businesses that we own in consumer and in healthcare that are going to benefit very substantially. And one of the benefits I want to highlight here is how AI has the potential to help with some of the big challenges we face in terms of sustainability. So with climate, it's very clear that there are a number of things that AI implementation will be able to address as a use case. And for example, it's greenhouse gas emissions, where if a city like London had just its traffic lights operating with it through AI and optimizing traffic flows, it could reduce 10% of the emissions that take place in London. And there are other functionalities and use cases that AI has in terms of adaptation, in terms of modeling and so forth, that we see and that we think are going to be significant drivers, both for demand for what AI does, but also for a positive impact going forward. And that leads me just on the topic of sustainability to give you a brief update in terms of where we stand in terms of the reporting, the integration, and the effort that we're making. You know that for us, sustainability is a core attribute of quality. We think only companies that are sustainable in the way they go about their business can have sustainable competitive advantage and generate sustainable returns over time. And so we think that that is very important, and there's no question at all about the importance of sustainability for quality. And what you see here is we've fully integrated ESG into our investment process, and we've submitted our second UNPRI assessment report, which is one of the several types of reports that we have to prepare in order to comply with the obligations and the commitments that we've made. And what we want to highlight is that we've received high scores above peer medians across all the modules that we've submitted for. And so given the size of our firm, the scale of the effort, the commitment of Katerina Kosmopoulou, our head of ESG, and Ryan Cook, our ESG analyst, we're very proud of the effort that we're making, and it's reflected in this recognition from the PRI. And likewise, we also continue to be active in collaborative engagement. It's across a number of initiatives. It's about water through the Valuing Water initiative. It's about plastics. It's about workplace mental health. And it's about overall health through investment and engagement with food companies. So for example, the Valuing Water initiative includes 8 stocks that are in the World Stars portfolio, where we are part of this engagement, and 17 of our World Stars stocks are part of the CSLA benchmark. With Share Action, we're working on discussing with Nestle ways in which they can make a commitment towards improving the health of the products that they have as a percentage of what they produce. And the engagement goes both in terms of the engagement with the companies that we're invested in, other investors, but also the organizations themselves, where we're looking to share some of our experience in terms of how you engage with companies and how you go about advocating for positive change. So with that, then let me get to the outlook in terms of both the macro and then some of the parameters that we look at for our portfolio. The macro is always going to be challenging. That's clear, as we've said, in the real world. Goldilocks is never just right. It's always too hot or too cold. And so in aggregate, the global economy is showing resilience. It's growing. It's somewhat below trend as defined by the IMF, but it's led by the US and by emerging markets. We are seeing inflation moderating, which is positive. We certainly are seeing interest rates now going back to normal. And we think it's very positive that at the end of last year, you saw the US long-term rates being set by markets, not by central banks. They arguably overshot from 4 to 5%. They've now stabilized. They went back below 4. Now they're just above. And it seems to us that's a perfectly reasonable market-based rate for where long-term interest rates should be. It means, given the overall setup, that the Federal Reserve is likely to engage in some rate cuts to bring the yield curve into line. Markets may allow them to do that. Again, we have to say, if that turns out to be delayed because the underlying economy is stronger, then that's something that might lead to another dislocation, but it will be another opportunity if it takes place. But very importantly, you have these strong labor markets that are still there, and we hear from company after company that we invest in, CEO conversations that we're having, that companies could do a lot more in the US if they could hire. And so that underlying robustness, we think, is likely to continue. Meanwhile, there's obviously elections coming up and debt levels are high, but we think that the overall setup is one that is constructive. And the really important part is our portfolio, because the quality attributes that Jerome was alluding to from the very beginning, that are at the core of what we do, are the ones that offer resilience, that allow us to go through a situation like 2022 when there's a dislocation, and to continue to have the confidence in the fundamental strength of the companies and their ability to manage through. And it's about all of these attributes. In particular, it's also about the growth they deliver. It's also about the robustness of their balance sheets, which means that they're able to act. And so we think these quality attributes that we look for serve us very well and will make us constructive about the outlook going forward. And the reason why we're saying that, and this is what I would like to leave us with before we go into the Q&A, is if we look at the metrics of our portfolio, then they're extremely reasonable. In fact, the spread to the overall market has widened. So we have revenue growth of close to 14% in the stocks that we own compared to 3.5% for the market, EPS growth of 19% compared to 8%, and importantly, margins of 28% compared to 10%. So very substantially stronger growth and profitability. We have a lower carbon intensity, as we've talked about. So we are investing in the companies that are disrupting, not the ones that are getting disrupted by climate change, carbon, and similar issues. And what you see here in terms of the valuations is, yes, the portfolio is trading at a premium to the market, but we think it is still extremely reasonable given the prospects. It's not as cheap as it was in the fourth quarter of last year, but we think that it's still a very attractive level that's entirely compatible with the overall environment and with where risk-free rates are in terms of present valuing stocks. And also importantly, while there are some parts of the portfolio that are approaching valuations that are close to in line with where we think they should be, there are significant parts that are lower, and the opportunities we see are now in particular in some of the areas that have been left behind, in particular in some of the consumer staples companies that we've invested in, some of the industrial businesses, and some of the healthcare businesses that have been affected, that have started to perform, but where there is a real valuation opportunity for this year. So with that, we'll pause. Thank you very much. And I'll hand it back over to Jerome. And we look forward to your questions. Thank you.